Small cap stocks for the loss? What? So you've always heard the small cap premium, all right? If you invest in small caps, you get a juice on your returns because small caps have done better than large caps since basically the modern era of investing. And that's always been up to debate. In fact, Jeremy Siegel's books that I will show you here will come into my library, and part of one of my libraries, if you will. You see Ludwig von Mises' Human Action, right? You see right here, stocks of the long run. And what Siegel came up with, he said from 1975 to 1982 or something like that, small caps had such a big increase over large caps that is what allowed to the small cap premium, because small caps did like 1,000 return over those 5 or 6 years, where large caps did 300, something like that. Take away that 5 to 6, 7 year period, and small caps and large caps do the same. Now, what financial planners, investment guys will look at risk-adjusted returns. What is the risk-free investment? All right, that's going to be your 3-month treasury bill. Compare that to your return and your various components. So if you have a 3% risk-free investment and you're getting 5% over here, you got 2% alpha above the risk-free investment, if that makes sense. You made 2% because because you took on more risk, all right? If you got 2%, then you lost money on a risk-adjusted basis and a full adjusted, because you're like, man, I only got 2%. I could have been at 3%, but because I took more risk, it actually hurt me in that regard. Does that make sense? So you're always looking at risk-adjusted returns. All right, so you're saying what could have got risk-free versus what I did get. And then you got to look at volatility as well. All right, treasury bills aren't very volatile. If any volatility, a little bit, not much volatility. Other things have pretty big volatility. So small cap stocks, in fact, there's an article I'm going to share with you, has a lot more volatility than large cap stocks because the trading area is smaller. There's just not as many volume in terms of stocks being traded. So because of that, there's bigger swings. So we're talking about risk adjusted relative to the alpha that you get over risk free, but also relative to your volatility. Right? That'd be a Sharpe ratio essentially. What do small caps do relative to large caps? And what we see here is that over the time from, like these guys say, 1926 to 2011, this article was written in 2011. I'm not even sure who the author is anymore, but I've had this article sitting there for a while. Small caps, well, I'll just read what it says. The long-held belief that small caps beat large caps on a risk-adjusted basis is simply not supported by the facts. So he's using 1926 to 1980 and then 1981 to 2011. He's using two different time frames. And if you look at the 1926 to 1980, small caps did better than large caps, but not on a risk-adjusted basis. Just in terms of total return, small caps did better. Not that much better, but not certainly not better when you look at risk-adjusted, right? And then you look at 1981 to basically 2011, small caps, large caps did better on both, risk-adjusted and just pure returns, right? And so what happens, very interesting here too, because he says right here, I want to share with you something. Many years back, going back, historically, small cap prices can be stale. This is like in the 1930s and 40s and 50s, stale because of the lack of trading during the month. So there's no volume there, and there's no volume. That you don't even know, you don't even get a bid. You could be asked all day long, trying to sell your stocks. You have no bid. There's no volume. So someone could say, look, man, there's no other price to give you $10 on the dollar. Like, large caps don't have that. Large caps have a much higher volume in terms of number of stocks trading, shares trading. So the large caps are inherently less risky in that regard into your ability to liquidate them for cash. Small cap stocks inherently are more risky. So from a risk-adjusted basis, small cap stocks have underperformed large caps. And this is just going to 2011. You take the last 13 years, small cap stocks have got destroyed relative to large cap stocks. Let's go to the new portfolio visualizer. There's two funds, it's a Vanguard Small Cap Index, NAESX. Isn't it crazy? I still remember this after all, isn't it? Yeah. After all these years having worked at Vanguard, and then VFINX. So we'll look at these two funds, and we're going to put, I got to change, actually, hold on a second, I put it up here. We're going to do NAESX. That's not ETF, mutual fund, NAESX. I mean, I worked at Vanguard 98, 99, 2000. I still remember the ticker for the small cap fund. Isn't that crazy? And then we're going to do VFINX, which is the Vanguard VFINX, the S&P 500, blank. I'm not selected. Oops, did I not do it here? VFINX right there. Crack out, and we're going to put that as 100 there. Get rid of that guy, and we're going to compare him for the last few years here. Blink, 0, and blink. So we're going to blink those guys out of there, and we're just going to compare these going back to, what does it go back to? Let's see what it tells us here. All right, so let's look at the, I guess the last 10 years. So we're going to look at the last 10 years, and we're going to see, I really screwed up portfolio visualizer. So we see, yeah, the S&P 500 is 10,000 invested in the S&P 500 is worth 31,000. 10,000 of the small cap index is worth 22,000. So going back to 1981 till today, the S&P 500 smoked the small cap index, not even close. Now again, that could change, I don't know, but again, the idea that there's some special small cap premium, that doesn't exist. It might have existed for those 6 years that Siegel's talked about in his book, Stocks the Long Run, and it might have existed in terms of total return from 1926 to 1980, but on a risk-adjusted basis, it didn't exist. And over the last 50 years, it hasn't existed at all, either. Anyway, so don't get caught up. But look, I have VTI. All right, so VTI, about 30% of that is mid to small cap stocks. All right, so if you want exposure to small caps, just buy VTI. That's a total stock index that will have small caps in there. Not as many as you might otherwise want, but you still have exposure to small mid companies for sure. But don't get sucked into these guys. Like I said, I think Paul Merriman and all these other. I have a friend of mine. I don't know if he did anymore. Like 10 years ago, I buy small cap value because historically small cap values outperform. It's just not true, man. It's not. It's. I mean, again, for a certain time, sure, but certainly not anymore. Again, that could change. I get it, but there's always an anomaly in the stock market. And then they always. Did I ever say why I'm sweating and stuff? I can't remember. I had to give my dogs a bath. This outside. So I was outside giving my dogs a bath and they're sweating like a pig, but they smell good, man. They are smelling good. Look at my cul-de-sacs. I should lose my hair because I got this little widow's peak there, but I definitely got a little cul-de-sacs back there. But yeah, maybe I'll dye my hair black like my man Fast Eddie says, you should dye your hair black. I said, dude, if my wife tells me to dye my hair black, I'm dyeing my hair black. If she tells me to keep dyeing my hair white, I'm dyeing my hair white. Other than that, Fast Eddie, no. I don't dig that. Okay, I don't dig a dude tell me what it look like. All right, love your thoughts. God bless. We'll see you.